Hi, everybody. This is Phil Blancato. I'm CEO and president of Latimer Dalman Asset Management, chief market strategist for Advisor Group. This is obviously our weekly market impact this week, but I'm really excited. I have a special guest on today from Janus Henderson, my fellow paisana, we would say in Italian. Well, welcome, Jessica Leoncini. That's how I would pronounce it. How do you pronounce your last name? Do you pronounce it Leoncini like that? How do you pronounce it?
Either way, I go with Leoncini or Leoncini.
Gene, okay, either way, it's all good. Um, so, real quick update from me. For those of you who know me well, this is a big weekend for the Georgia football team. I'm a big fan, Jess, of the Georgia Bulldogs. I have two daughters that go to the University of Georgia, so I start off our podcast every week with a little personal stuff. Just for fun, it's Tennessee, Georgia this weekend, and my niece is a soccer player for the University of Georgia. She's her last name is Latino, but Luciana Latino. So if you happen to be watching highlights from soccer, you see she's a very talented young lady. You can catch her on there. But so it's a bit of a family rivalry weekend, and not to mention Tennessee's a good football team. So there's a lot going on. My older daughter Luca Gianna will be driving down to, already is on her way there to Tennessee to spend the weekend at Tennessee. I've always wanted to go on the river there. I hear it's a lot of fun to go down there on a boat and be there for the river and on a boat for tailgating and going to the football game. It's supposed to be one of the loudest arenas in the country. So I hope those Georgia Bulldogs can pull it out, but it's going to be a fun family discussion if Georgia loses or wins for that matter, no matter who wins. But I'm definitely a Tennessee Vols soccer team for my niece there. Very exciting. For those of you who like a tomato update, Jessica, I plant 100 tomatoes every year. We have these two gigantic gardens. It's a long story about how my dad was this larger than life Italian guy and planted these huge gardens. Well, we preserve the tomatoes. Well, the count is close. We're over 200 this year because the garden's going gangbuster of preserved sauce. And I got a lot of questions this week about how I do it. So for those of you who want to know how it goes, and by the way, I have to do another batch tomorrow. I have it just the garden just won't give me a break. Tomorrow's the last batch. Anything after this will give back to friends, family, and the earth. I've been eating so many tomatoes, my potassium levels have to be off the
And
charts.
do you have a good Sunday gravy planned with those tomatoes?
Now, Jessica, we do not call it gravy. I like you. You're my friend. It's sauce. There's
Okay.
marinara, there's bolognese, there's ragu, there's a pesto. I mean, come on. Gravy, that's an old New York, Long Island thing. We gotta modernize you a little bit. It's a salsa marinara, salsa, oh, come on. But you're right, kidding. Okay, aside. I make very good homemade sauce, a ragu sauce. The way we do the sauce is we literally pick the tomatoes, we boil them, then we puree them, boil them again, and then the second boiling we season it. So when you put it in a jar, it goes in hot. I'll open it up and it's ready to eat. But I still reduce it a little bit with olive oil and garlic on the bottom of the pan, sometimes a little onion. But to your point, I'll add in my favorite meats, and I like to mix it up. Sometimes I'll use neck bones, sometimes I'll use different types of meat. I'm a big fan of the three meats for meatballs, obviously veal, pork, and beef. A little more fat's never going to kill you, but it makes the taste a lot better. So that's my quick how I do it. But this will be hopefully my last batch. I mean, we've been going absolute gangbusters with tomatoes in New Jersey. We've had a hot August, well, a warm, sunny August, and that's what you need for the tomatoes to be perfect. And this year, they're like eating candy. But on
You're
a
making
sec,
me hungry.
what's that?
You're making me hungry.
Oh, you got to come out, Jess. Jessica's a Long Island girl now lives out in Denver, but or Colorado. But I still argue the best food in the country is here. Now Denver's a great city, great food, but there's nothing like the food out here. I travel the whole country. I still,
Completely agree.
except for maybe fish. If you want to do fish, sure, there's much better places for that. But in any event, it's been a lot of fun. The other fun highlight for me is we have our gigantic industry conference next week called Connect Ed. Thousands of people will be there. I get to give a 45-minute keynote on economics. For those of you who are coming, and I know a lot of our end clients listen today, so you might not see that it might be out on our website at some point, but I've got some fun hidden things in there and a little fun comedy skit I'm going to do with my partner, Jamie. So lots of fun coming for those who are going to see it connected. Looking forward to it. And then one other quick thing. It is baseball time, Jess. Now I know pro football's kicked off, and we're in the middle of certainly college football. But are you a Yankee fan or a Met fan?
I'm a Mets fan, and you are a born a Mets fan. That is not a life you choose.
I understand you're a Long Island girl, and I respect it. I honestly thought the Mets were going to win the whole thing this year because you guys got Soto. But like the Yankees and like the Mets, they're both falling apart. So for all my Yankee brethren
Per
out there, I
usual.
don't hate the Mets. I'm not a Met
You
hater.
can't get too excited too early in the season.
No, I'm not a Met hater. The Mets one, I'd be okay with that. My wife likes the Mets. Um, To all my Yankee and Met brethren out there, I'm sorry to say we're not. It's not looking good. I mean, we just got smoked by Detroit games in a row, and to make it worse, while we won yesterday, we still got a bunch of guys hurt. So, unfortunately, Jessica, it's time to start thinking about college football. And the Giants lost weekend one. The Jets lost weekend one. I'm a Rams fan. They did win barely. I like both the Giants and the Rams. So, lots of personal stuff going on. Good times out there. But I'm excited to have Jessica on. Jess, why don't you tell us a little bit about yourself? What do you do for Janus and maybe a little bit about your career and how you got here?
Yeah, absolutely. So I'm Jessica Leoncini, as you mentioned. I am the head of fixed income client portfolio management here at Janus Henderson. So I've been with the firm for over 11 years now. As you mentioned, relocated from New York quite a while ago to Colorado just to enjoy the mountain lifestyle. And in my role, I do a lot of things like this. I engage with our clients. I help them understand our portfolios, the markets, what we're thinking. And it's really a fun, engaging job. I have had a variety of roles over my career. I'm one of those people that probably never had a 5-year plan, but just leaned into opportunities as they presented themselves.
I like that.
So I've worked for a variety of firms on more of the intermediary side, on the institutional side, another asset manager, and just continue to take opportunities in fixed income. I think it's the funnest side of the house. Even though a lot of people may think fixed income is boring or complex, it's none of those things. So that's how I've gotten here.
I think it's cool. I mean, you're obviously a great success and you love bonds. And bonds are pretty boring. You can make bonds exciting. So I kind of like that. I mean, most people call them boring. I don't think they're boring. I think they're wonderful, but a lot of people think they're boring. So good for you. That's pretty cool. Well, a question for you. When you think about your career path, a woman that's successful in finance, kudos to you. Is there for the ladies that listen to this, any advice you give out to the gang for you're as a successful woman? And not that we delineate, but you are. So it's kind of cool. We've had successful women on. I always like to ask them, how did, was there something that you were ever figured out that made you more successful? Or was it just, like you said, leaning into it?
So one of the things my dad always said to me when I was growing up is you can do anything you want to. And I sort of took that to heart and just followed things that I was really interested in. I was a math major in college, so I was always in areas where I was one of the few females and just really liked more of the analytical side. So I think the best thing that you can do in your career, whether you're a woman or a man, if you're earlier in your career, just leaning in, accepting opportunities, raising your hand to take on more responsibility, and just learning. I think a lot of what I did was ask questions, be curious, try to learn more about things. And I find that always opens up opportunity if you're the person trying to learn more, trying to better yourself. And then one thing that I really like to do is surround myself with people that are smarter. I think some people can feel intimidated around really smart people. I think that's the best way to continue to grow and make yourself better. Surround yourself with people that are smarter than you, that know different things, that can complement your skill set. And I think everyone is better off for that.
I love that. That's great. You said something, lean into it. You know what that means to me? We're both old school Italian kids. Work hard, work really hard,
Work hard,
work
exactly.
really hard, and a lot of good things happen. That's was my philosophy because I didn't come from a pedigree like most people do, and just working hard and asking questions. I love that. It's good for you. The bond market's been a crazy place. When I look at markets year to date, we're hitting all-time high in the equity market, stock market through 12%, Nasdaq through 15%, international markets through 22. Everybody's forgotten about the bond market. Another good week. All the rave about the Fed, the Fed, the Fed. I'm so sick and tired of the Federal Reserve, and on the way in, on the way out. God, hopefully it's the way out. But certainly, when we look back at what 2022 did to the bond market, down 13, almost 14%. And this year, finally, we're at over 6% on the Barclays Aggregate Bond Index. Your thoughts? What's driving the markets higher this year? What do you think is the catalyst?
Yeah, we have sneakily put up really good returns in the broader bond markets, and a lot of that is the income that we have on bonds. So if you think about the problem that we had a couple of years ago, we went through zero interest rate policy for so long, right? The big joke was, well, there's no income anymore and it's not fixed within fixed income. So when you are starting from zero interest rate policy, which we had post 2008 when the Fed had to drop rates, post 2020 when the Fed had to drop rates, it's really hard to generate attractive returns when you're starting from such low levels. That was the problem that we saw in 2022. right? Everyone looks to fixed income to be that diversifier to your equities. That's generally why you own it, because if something happens like a 2008 and stock markets come down, you expect your fixed income to be there, to be that ballast within your portfolio. But when you were starting at low absolute levels of rates, you were just not able to have that benefit within fixed income. So 2022, although a lot of investors really focus on that, was just one of 4 years in history where you saw that correlation of bonds and equities go to one. And all four of those environments was when inflation was very high and continuing to go higher. So we are in a very different environment now where we're starting with very attractive base levels of yields. If you look at core yields within the Bloomberg Aggregate Bond Index, which is the main index that a lot of investors look at, you're over 4.5% in terms of yield for that index. And then a lot of other areas of the market are offering even higher yields, 5, 6, 7%. So that carry game is really important within fixed income, what that coupon is. In equities, you think of how high your stocks can go. In fixed income, you want your money back at the end of the day. So
Yeah,
that
the
income
duration, like how
component
long it
is
takes to get my money back. Yes, I'm sorry. Go ahead.
exactly that income component is such a key driver, and that's really what's helping markets today.
Well, that's very helpful because I think there's a lot of folks who listen to this who remember if you look at 1980 to 2000, you made really incredible returns. Every year you were getting 6, 8% on your bonds, but still getting a pretty incredible yield. Interest rates were going down, but you made more money and you made lots of income. Then we had this 10-year period or so of bonds were just insurance. You didn't make a lot of return, you didn't make a lot of income. If the world went to heck in a handbasket, they would protect you because in the idea they own bonds to be safe, but they certainly weren't a moneymaker, and they feel like they are again. Maybe take a minute and explain that. I'm not sure everybody understands that. If yields are at 4% and they go down to 3, why do you make money?
Yeah, so a couple of things to kind of highlight here. So, one that I like to look at is in our industry, we never guarantee future returns.
Yeah.
But the exciting thing about fixed income is that it's math. And that may seem counterintuitive, and you're going to give me a hard time about being a nerd and, bonds and math not
I
being
like
exciting.
math. I love math,
The
actually.
good thing is it's predictable. So if you just buy a 6% bond, a bond with a 6% yield, you have a really good understanding of what that potential future return looks like. And if you map out over the long term, over the next 5 to 10 years, your returns in fixed income are about 98% correlated to that starting yield. So if you assume no price appreciation, if you just buy a bond, you hold it and you clip that coupon, that yield is essentially what your return looks like. But now we have the likelihood that the Fed starts cutting again, right? The markets have priced in essentially a 100% chance of a cut next week. And if you think about the impact there, that's a good tailwind to fixed income, right? Because your duration, we're not getting into the big seesaw analogy, but rates and yields move in opposite directions. So as your rates come down, you get that price appreciation tailwind. So in fixed income, you can generate returns not only from that income, but from that price appreciation component. So on the front end, and we should be pretty specific since there's some divergence between the front end and the long end today, on the front end, that's a pretty good tailwind for driving additional returns within fixed income.
Yeah, so think of it this way, everybody. If you bought a bond today and a 10-year U.S. Treasury bond yielding 4% as of today, and 1 year from now, because the Federal Reserve cuts interest rates, it's not a guarantee, but let's assume that 10-year yield goes from 4 to 3. Well, guess what? You still made your 4% for the year in the income, but that price of that bond, the one that you own, is going to go up. And the reason why? Because the bond a year from now isn't as interesting as the bond you bought today, because that one yields 3, the one in the future for 3 versus the one today at 4. So you get two things. To Jessica's point, you get this wonderful income of 4% if you bought it today for the next 10 years. But you might even see the original price of what you pay for it, the value of that bond go above it because people want to buy that bond. Why? Because it's yielding 4. So what's happened this year, which I think, Jess, is pretty exciting, being at 6%, if all things stay equal, I'd love to see what you think about the Federal Reserve. But with a Fed cut, isn't it safe to say the bond market probably, depending on where you're looking, short maturity bonds of 1 to 2, 3 years for sure will go down in yield. But there's a chance the longer bonds, not I think less so, that might go down as well. So one, do you think the Fed's going to cut here next week? If you do, you think it's quarter of 1% or half of 1%. And at that, what does it do for yields? So let's start with the Fed. Do you think they're going to cut next week at this point?
Yeah, it seems like we're in for a 25 basis point cut next week. I would say nothing is a guarantee.
Yeah.
And they have a really hard job right now with the conflicting data that's coming in. We've
Hmm.
seen that jobs numbers are looking like the jobs market is weakening to some degree, right? Not to an alarming degree. The economy is still on very strong footing, but we're seeing some weakness in the jobs market. But we're seeing inflation start to tick back up. And if you look at the Fed's dual mandate, those are the two things that they're watching. They're watching price stability and full employment. So, where is inflation and where is the unemployment rate? But with that, it seems like there's enough data stacking up that they can cut. Remember, they're still moderately restrictive, they're still well above that neutral rate. So, they have a lot of room that they can cut. We've also seen a lot of other central banks around the globe cut more aggressively, cut sooner. So the Bank of Canada, the European Central Bank have already cut multiple times in their economic cycle. So it seems if I'm going to bet, I would bet for a cut next week. But it is interesting when you look at the full yield curve, right? The Fed can only control the front end of the curve. What a lot of investors have been surprised by is the long end of the curve actually moving up, right? So a little bit of that disconnect. But if you actually look over history, in 14 of the past rate cutting cycles, the long end has moved higher in 8 of those. And that's because the Fed doesn't control the long end of the curve. It's inflation expectations that's
Right.
driving that. So, going back to exactly what you said earlier, if I'm going to buy a 10-year bond and I think inflation is going to be running relatively hot, I need to be compensated for that to be able to preserve my purchasing power in the future.
That makes a lot of sense. Purchasing power means you want to get your money. So
Exactly.
it's a lot there. And I want you to think about this, everybody. Last week, we talked a little bit about how CPI was going to be important, and that came out this week. And it wasn't great. It was okay. But we're still looking at headline, the one that includes food and energy, pushing up near 3%, and the one that does not include food and energy above 3%. We saw PPI come out, wholesale goods, which is very volatile, and what it sort of costs to make things. That also came out a bit easier than expected. So that may mean future inflation is a little lower. But when we look at the services component of it, it certainly suggested that rates are pushing higher. And more importantly, goods are now up 5 months in a row. So to Jessica's point, inflation is not going in the direction the Fed wants it. They want it lower, not higher. But yet the job market weakening, we saw this crazy revision number of 900,000 jobs being a mistake. So instead of adding 200,000 jobs a month, we added 120, and now we're adding zero in the last couple of months, really. So to Jessica's point, there's a weakening labor market. So let's go back to where this all began, everyone. The Fed was cutting because they wanted lower inflation. Well, guess what? That's not really happening anymore. It's kind of flattened out. Now they're cutting because of the labor market, which I think is very dangerous. If the Fed comes out and says we're going to cut, even though we didn't get the inflation number we want, we're cutting because we're worried about the labor market. I think that would be really hard on the equity market. And the winner in that, at least on the short bonds, less than 5 years, would certainly be the bond market. I think. What do you think?
Yeah, and I think that's exactly why people hold fixed income, right? We've seen a great move in the equity markets, and that's been very warranted, right? Earnings have been very strong,
Yep.
labor productivity has been strong. We've seen a lot of industries adopting AI and seeing that implemented beyond just technology, seeing that in the communication sector and the financial sector. So there's been good reason for the movements we've seen in the equity markets, but fixed income is really there for that ballast, as I mentioned earlier, right? It's there if things are a little bit wobbly. And in the equity markets, you want very strong growth. You want companies to be innovating and doing new things. In fixed income, just kind of hobbling along in growth and having a little bit slower growth is okay. We don't need record growth to be able to continue to see strength in the fixed income markets. So we're seeing strength on both sides. Within the corporate markets, you're seeing a lot of the same benefits that we've seen within equities. You have strong earnings continuing to support that. Leverage ratios are relatively low, right? Companies in general have been prudent stewards of their balance sheet and have been paying down debt. They're able to service that debt, and default rates are very low, right? They're low within the high yield markets. Stress levels are still relatively low. And then on the other side, the consumer still remains relatively strong. I know
Yeah.
there's some issues with, kind of call it that bottom decile earner. But you have a consumer that, broadly speaking, has seen home price appreciation if they own a home, has seen appreciation in stock portfolios, and has also been pretty good at paying down debt. So overall asset levels relative to debt remains relatively strong. So there's still a lot of good pockets of strength behind the overall markets. And if you do see areas of weakness, that's where fixed income tends to shine.
Yeah, I think couldn't have said it better. We talked a bit on the podcast how the folks who are over the age of 65 are better off than they thought they would ever be. So incredible returns for them. And then beyond that, their ability to spend from the idea of first class tickets on Delta are more popular today than economy because I think it's a lot of folks who are made more money in their house and in their stock count than they ever thought spending. And you're seeing that hold up the U.S. economy a bit as well as AI spending. But I think you're right. We're in this kind of slower growth environment, but not falling off a cliff, which to me is the perfect place for fixed income because we don't have this. I don't think there's a real scare that inflation's going back to 4%. We might see it be a little bumpy because of tariffs, but nothing significant. Would you agree with that? We're not overly concerned about the tariffs.
Complete. Yeah.
And
Uh,
then, I'm sorry, go ahead.
nope, go ahead.
Well, and then we have this environment where the Fed might cut two, three times this year. And I still think the winner for that is stock market's priced a lot of this in already. I don't know if the bond market has. It's taken a while for the 10-year to go from 4.7, I guess, down to 4. Where do you think the 10-year could end up if things stay like they are? Kind of modest growth, the Fed's cutting because it's kind of getting its way in inflation and just unemployment doesn't get a heck of a lot weaker. I feel like this quote unquote natural rate or neutral rate where the Fed should end up with where the real rate of inflation is, where the real rate of borrowing and lending is, means that to me the 10 years should be a bit lower, but I can't really figure out where. Where do you think the bottom end might be?
Yeah, I think we're going to be range bound, right? You'll be
Yeah.
bouncing around in a little bit of range. It's really hard at this time to determine what that exact number should be because we still have so many uncertainties, right? And you're still seeing some of that tariff impact just start to come into numbers, right? We didn't really have that impact as you were selling goods that were coming in before tariffs actually were implemented. And then don't forget, we're largely a services economy,
Yeah.
right? So a lot of what's contributing to GDP is what you said before: airline spend, travel and leisure, right? Cruise lines are seeing it, hotels are seeing it. In terms of the actual durable goods that are subject to tariffs, it's a relatively small part of our overall economy. So I think as we continue to see conflicting data on the job side, on the inflation side, you'll continue to see those movements in the long end. I think you can protect against that. I think you can be more on the front end of the curve. I think you can be in some sectors within the bond market that have higher yields and those areas that give you a better probability of success than trying to predict the 10-year. I think predicting rates has typically had a lower Sharpe ratio of return, right? It's harder to predict. Where if you think about managing an overall bond portfolio, picking companies and assets that you can underwrite and understand and capture strong yields, that's a much better way to put together a sustainable portfolio and return profile.
Balance, the beauty of balance in there. So there is a black swan moment I want to talk about, but I'm going to save that. Tell me, Bill, about Janus. And there's bonds is a broad term. There's treasuries, there's corporates, there's CLOs, there's a crazy thing called CLO, a loan bond. How do you guys navigate the world of fixed income? Where do you like in all those types of bonds? And maybe a little bit about your firm and how you help people.
Yeah, absolutely. So we manage over $160 billion in assets in fixed income broadly. We have
Wow.
over 130 fixed income professionals that help support that. And we really manage across both multi-sector and single sector portfolios. So depending on where you are in the risk spectrum, we have solutions across the board, and then solutions based on whether you want to outsource that allocation decision and say you find the best areas within fixed income, or for those asset allocators who say, I know exactly those allocations I want, and I need active solutions in this space and this space. So we want to make sure that we have all of those options available to our investors. Today, some of the areas that we like are securitized assets. So this is where we start to get into that fallacy that fixed income has a lot of complexities. There is a lot of jargon, there are a lot of acronyms, but securitized essentially just means something backed by an asset. So I think familiar to a lot of us listening today, mortgages, right? A lot of homeowners will have a mortgage. They know about locking in an interest rate, about submitting their credit score, their FICO score, thinking about all the variables of, do I want a 15-year or 30-year mortgage? Do I want to buy in New Jersey or Colorado? So these are assets that should be very familiar to people. And those are things that we can invest in on the other side. So things like auto loans, things like commercial properties, data centers helping to support all of the AI infrastructure, or marquee hotel properties. These are a lot of areas that are offering attractive yields, so helping with that carry component, helping with that return component. But a lot of them are very high quality in terms of not having to buy things that are high yield or below investment grade rated. So Securitize offers a lot of really interesting opportunity today. I would also say global markets have some opportunity. So I had mentioned that economies are in different areas of their rate cutting cycle. So US seems to be next up to see some more cuts, but areas like Australia or New Zealand are also in the mix there. Also things like emerging market debt. A lot of people
Not a
don't.
problem with currency. Do I buy it in local currency? Do I buy it in dollars? How do you all look at that space?
We manage hard currency
Okay.
because local currency just adds a different level of volatility. But if you look at the EMD market, a lot of people don't realize that half of that is investment grade. And most of the high yield issuance within that market is in an IMF program. So a little bit of stability there. But I think that's where diversification really makes an impact in finding those assets, really taking an active approach. I would never recommend just buying a whole sector outright. I think active is certainly something that's very important within fixed income.
Yeah, I think you're absolutely right. So that's why handing it off to you all to manage versus someone trying to do it on their own individual slices is difficult. Question for you. So when we think about bonds, to me, they went from boring to beautiful. And the reason why you 6% with not a lot of risk, but risk is the thing, right? There could be things called defaults. You mentioned auto loans before. We've seen a tick up in auto loan defaults. We're seeing a bit of a tick up in credit card defaults. How do you guys manage, defaults? Do you just buy really good stuff, or can that happen? What is a default, or if you will, what does it mean?
Yeah, that is the importance of doing the underlying research. So that is what we pride ourselves on at Janus Henderson, is underwriting all of these individual issues. So really understanding, we have a corporate team that looks at corporate bond issuance. They're looking for upgrades, right? So we talked about income and price appreciation potential earlier. If you have a bond, and remember, the ratings agencies are typically backward looking. We learned that in 2008, if we didn't already know
For
it.
sure.
The the ratings agencies are backward looking. So a lot of times they won't capture what a company is doing to better their balance sheet or pay down debt. So if we can identify companies by talking with CEOs and CFOs to understand their path, we might be able to find companies that are actually going to be upgraded. And then you see that price appreciation potential. So that's a positive there. We do want to avoid those names that we think are weakening, that would be at the risk of default. And remember, when you're looking across the broad market, you're starting with your highest credit quality of AAA, and then you continue to go down from there. So AAA, AA, single A, triple B, all investment grade rated. Once you get below that, you start thinking about high yield or below investment grade. So as you go down in that credit quality, you really have to be careful to be able to understand the company and the direction, what their cash flows look like, what their business looks like, especially today where there are going to be winners and losers in the market. Right? When there's a cost of capital, when rates are where they are, there's going to be companies that can navigate well and ones that maybe aren't innovating or are losing share. That's also why securitized assets are interesting, because in a corporate credit, you buy the company that you like and you just assume that rating In securitized, you can actually pick that rating profile that you're interested in, right? It's called a tranche amount. So you can pick that actual rating that you like. And if it's a securitization that you're very comfortable in, maybe you buy something a little bit lower quality. If it's one where you want to stay high quality, you can pick that AAA tranche. So there's a lot of opportunity to be able to navigate and find exactly what you want.
Yeah, I think that's very important and very impressive because the idea is we don't want to make a mistake of going into something safe and suddenly it's not safe. And I get the value of taking risks, you get higher yield, but that's the balance we work strive towards. Well, I mean, this has been a lot of fun. Hopefully, the folks that think of bonds as an afterthought because you just want to own NVIDIA realize there's beauty in balance. But there is one thing out there that spooks me a bit that yields could go higher if, in fact, the Fed gets it wrong or inflation goes higher. But there's another thing that's kind of wonky that's out there. What if the Supreme Court decides that tariffs are illegal and the government's got to write a $300 billion check back to a bunch of different places, and the bond market's got to write that check? What is there a scenario, whether it's inflation or that is with the Supreme Court, that would create higher interest rates, which would then be not fun for the bond market?
Yeah, I think there's certainly a risk like that. And that's where you're seeing some of those other implications in longer term yields being priced in as well. So one thing we didn't talk about is the fiscal deficit.
Yeah.
And that's, we did talk about inflation and how that's impacting the longer end of the curve as investors need to be compensated for what they think will be persistent or relatively higher than that 2% inflation. But the fiscal deficit plays into that as well. So you talk about defaults, and that's not something that I would ever say that, we're at a risk for with the US government, but we have been downgraded by all three of the major agencies from AAA, right? We're no longer, our government debt is no longer AAA rated. And that's an indication of the view of our fiscal balance sheet. So I think if you're conflating or inflating the issues of what our debt levels look like and the potential that that could increase, I think there's absolutely, that could have some implications for the bond market.
And we've talked a lot about that on this podcast about how the government is writing $1.3 trillion in interest payments alone every year. It's unsustainable. So it's the second biggest line item on the government's balance sheet after Social Security, Medicare, Medicaid. And that means a lot of people got to buy our bonds in order for us to keep going. And if we don't get our fiscal house in order, which would be another fun podcast, whether it's Social Security or specifically just the amount of debt that we have, it's a problem. If we start issuing more of it, then the interest rates go higher because people are going to demand more income because they're having to buy riskier debt. I mean, just like we talked about a minute ago. This has been fun, buddy. A lot of fun. So we're at that moment where I'll give you a last say on the bond market. Anything you want to leave folks with? I mean, it's not insurance anymore. You can make money in it. But what do you think? What's the last thought on the bond market?
Yeah, I would say stay active within fixed income. Don't shy away with the absolute levels of yields that the bond market is giving you right now. It does look very attractive. And I would say don't get stuck with the benchmark. So a lot of people don't realize that the benchmark doesn't represent the broad opportunity set, right? In equities, if you grow, you're rewarded with a bigger allocation within the benchmark. In fixed income, if you issue more debt, you get a bigger allocation within the benchmark. So if you look at the traditional aggregate bond index, it's a lot of government related debt, a lot of long duration, low yielding debt. So this doesn't include anything below investment grade, anything floating rate, most of the securitized assets. So there are trillions of dollars that are not represented within the ag that can truly add yield, add diversification, reduce correlation. So I think there's a lot of opportunity out there for fixed income investors that are looking to be active, looking to diversify, and willing to expand their overall opportunity set.
That's why I hire an expert firm like Janus Henderson to help you figure that hard stuff out. I couldn't agree with you more. All right, so here we are. Time to wrap us up. Like I mentioned, a very big weekend. It is a bit of an Indian summer going on out there. I know out in the Midwest it's hot and sunny, right? You got a lot of sunshine in Denver right now, I think.
Yeah.
And before it's gone, everybody go and enjoy it. In New York, we had a really nice stretch. It's beautiful today, 75 and sunny. And tomorrow, I think it's the same, so I can make my last batch of tomato sauce in the sunshine. Time for my shout out of the week. Do you have one that comes to mind? I'll let you go first. If one comes to mind, something or somebody you want to note that you think did something spectacular recently?
I would like to shout out first responders. So we had a school shooting in the town that I live in this
Oh my
week.
gosh. Yeah.
And the first responders were incredible. my husband's an educator, so it's something that hits very close to home. So just very grateful for all the people that are out there on the front lines. Thank you for everything.
I could. That's a great one. I couldn't agree with you more. And thank God, I think there were just 2 kids wounded but didn't pass, and the shooter, I think, did pass, if I'm not mistaken.
Right.
I don't understand this stuff. So much is in the headlines right now, Jess, and we don't want to end on a somber note, but certainly what would happen with Charlie Kirk, and I don't pick sides. I don't care politics. Well, you know, I'm apolitical. But just to be shot for your opinion on front of thousands of people is just lunacy. School shootings, lunacy. This makes no sense. How did we get so angry with each other? I guess I was talking to my daughters about it. When Martin Luther King was shot, I'm sure there was a lot of the same anger. John F. Kennedy, Robert F. Kennedy, Ronald Reagan. We can go down the list. I don't know that this is the first time ever we've had discourse. I don't remember school shootings as a kid, so that feels new. But certainly political stuff is not new. It's just a shame that we're at that place. But I'm going to pivot. I'm going to pivot, and then on a bit of a high note, because you're right, first responders. I want to celebrate the folks who helped us get past 9/11. I was in New York City that day. I was 2 blocks away, 3 blocks away from the Trade Center. I watched both buildings fall. I lost a bunch of friends, but that's not my point today. I want to remember those folks that passed, but I'm going to take for a minute and tell you a story. My story is for all the tragedy that happened at that time, there was this moment of amazing brilliance that I'll never forget. The market had been closed for, I believe, 6 days in a row, and that had never happened before. So we finally go back to work, and the only go back to work was by tugboat, by boat, excuse me, ferry boat. I get on the ferry boat. It's still quiet. The air was if it was, you could almost touch it. It was so quiet. We get off on downtown Manhattan. I get off the ferry boat, and everyone is very concerned. Some folks are weeping. We could see it was tense, and somebody hands out American flags. And as I look out, there's thousands of little flags everywhere, and there's TV crews. And you know, at that moment, people started chanting USA and clapping their hands and cheering. Not because it was our moment to say, you know, we can survive this. We can get past this. And I never forget that moment of patriotism for me. Well, mom and dad were proud Italian Americans. They were, you know, owe everything to this country. I remember going to work that day and being excited to go there and watch the bell ring and watch the statue. There was a picture of Statue of Liberty rolling up her sleeves, kind of ready to fight. And I'll never forget the way we all banded together and moved past that. Never forgot, but moved past that moment. And in that moment of sadness, there was this great unity, and to all those people that helped the first responders at that moment that passed and got us through it, and the way that we've rebuilt downtown Manhattan without forgetting the museum. So my shout out is to the folks that passed and the folks who helped us get past it. And that moment of American pride that I'll never forget. It will hang with me till I'm dead. And hopefully, right now, we'll figure out a way to get back to that. Whether it's this what happened with Charlie Kirk, the tragedy there, the school shooting in your town, the school shootings that we've been having. There's got to be a path to us being better than that. So I think there is. I think 9/11 showed us their way, and maybe we can leave some of that again today. It's been a pleasure.
Goodness and hope in the world.
Yes,
so we can't forget.
Absolutely. You can go to Italy. There's a lot of that there. It's been a pleasure to have my new friend, my Italian paisanella, on with me today. But thank you for joining us today, Jessica. It's been a real pleasure.
Grazie.
Grazie mille, cara mia. Everybody have a wonderful week, and I'll talk to you all next week. Bye-bye.